Most people believe putting money into a savings account is the safest and smartest financial habit they can build. Saving money feels responsible, disciplined, and financially mature, so it becomes the advice nearly everyone hears from a young age. But there is a quiet contradiction hiding behind this habit that most people never question. Many people save money consistently for years, yet their financial life barely improves in any meaningful way. Their bank balance grows slowly, but their long-term financial security somehow remains fragile and uncertain. This creates a strange situation where someone can feel proud of saving regularly while still falling behind financially over time. And the surprising reason behind this contradiction is a financial behavior banks quietly benefit from. For most people, the savings account feels like the safest possible place for their money. It is simple, familiar, and constantly reinforced as the responsible financial choice by parents, teachers, and financial institutions. When someone deposits money into a savings account, it creates a sense of progress and financial control. The number slowly increases, and that visible growth creates the feeling that wealth is gradually being built. Because of this emotional reassurance, very few people ever stop to question whether the habit is actually helping them move forward financially. The behavior feels harmless and even responsible on the surface. But over time, something subtle begins to happen that quietly weakens the long-term value of that money. And most people never notice it happening. Imagine a young professional named Daniel who recently started his first stable job after finishing university. Daniel earns a reasonable salary, lives in a modest apartment, and carefully tries to follow what he believes are responsible financial habits. Every month after receiving his salary, he transfers a portion of his income directly into a savings account. At first, this habit feels incredibly satisfying because Daniel can see his balance slowly increasing every few weeks. Watching the number grow gives him confidence that he is building a secure financial future. Whenever unexpected expenses appear, Daniel feels relieved knowing that he has money saved. From the outside, his financial life appears responsible, stable, and well organized. But over time, something unusual begins to happen. Even though Daniel continues saving consistently, his financial progress feels strangely slow. Years pass, yet the amount he saved never seems to create real financial freedom or meaningful financial growth. And Daniel quietly begins to wonder why saving money does not seem to be changing his financial life the way he expected. The answer lies in a financial habit that almost everyone accepts without question. The first mistake begins with a simple assumption most people never challenge. Many people believe the purpose of saving money is simply to store it somewhere safe. A savings account feels like the logical solution because it protects the money and allows small amounts of interest to accumulate. But this creates a psychological illusion that the money is working and growing over time. In reality, the growth happening inside most savings accounts is extremely small. The interest earned often feels visible, yet it rarely keeps up with the real forces quietly affecting the value of money. Because the number in the account slowly increases, people assume their financial situation is improving. But the truth is more complicated. And this misunderstanding slowly leads to a deeper financial pattern that affects millions of people without them realizing it. Mistake 1: the comfort of safety. Savings accounts provide something people value deeply when it comes to money. They provide a strong feeling of safety and certainty. When money sits in a savings account, people feel protected from financial emergencies and unexpected problems. This emotional comfort makes the habit extremely appealing and easy to repeat. But safety alone does not automatically create financial progress. If money simply sits in one place for many years, it may remain protected, but it does not necessarily grow in a meaningful way. Over long periods of time, financial progress usually requires money to do more than simply exist in storage. Mistake 2: the invisible effect of inflation. There is another financial force quietly affecting money every single year. This force is inflation, which gradually reduces the purchasing power of money over time. Inflation means that the same amount of money slowly buys fewer goods and services as years pass. If a savings account grows very slowly while prices in the economy rise faster, something important begins to happen. The number in the account may increase, but the real value of that money slowly decreases. Imagine someone saving money for 10 years while the cost of living continues rising every year. At the end of that period, the account balance may look larger. but the actual buying power of that money may be smaller than expected. This is one of the most misunderstood financial realities people face. Mistake 3: mistaking storage for growth. Many people unconsciously treat savings accounts as a long-term wealth-building tool. But in reality, savings accounts are primarily designed for short-term storage and emergency funds. Their purpose is to keep money accessible and protected, not necessarily to grow wealth significantly. When people rely on savings accounts alone for many years, they unintentionally limit the financial potential of their money. While their income may increase and their savings may grow slowly, the money itself is not actively working to create additional wealth. This creates a situation where someone can be disciplined with saving yet still struggle to build meaningful financial progress. The deeper reason behind this mistake is not a lack of intelligence or financial discipline. The real reason lies in human psychology. People naturally prioritize safety and certainty when it comes to money. A savings account feels predictable and secure, which makes it emotionally comfortable. But financial growth often requires thinking beyond pure safety and understanding how money behaves over time. Most people never receive education about how different financial tools serve different purposes. So they simply repeat the habits they were taught early in life without questioning whether those habits still make sense later. This is why many intelligent and hardworking people continue making the same financial mistake for years. There is a simple framework that helps clarify the role money should play in different parts of your financial life. Store, protect, grow. Some money should be stored safely for emergencies and short-term needs. Some money should be protected for financial stability. But some money should also be placed where it has the potential to grow over time. When people treat every dollar as something that must only be stored safely, they accidentally remove the growth component from their financial strategy. And over many years, that missing piece quietly limits their financial progress. Once people begin understanding the difference between storing money and growing money, their entire perspective on personal finance begins to change. Savings accounts still play an important role because financial security always starts with stability and emergency preparation. But real financial progress usually happens when money begins participating in systems designed for long-term growth. The key shift is awareness. When someone becomes aware of how money behaves over time, they begin making decisions more intentionally. Instead of simply storing money and hoping it slowly accumulates, they begin thinking carefully about how each portion of their income should function. Some money protects the present. Other money builds the future. And that simple awareness often becomes the turning point in someone's financial journey. If this video changed the way you think about saving money, comment awareness below. And if you enjoy calm, thoughtful explanations about money and financial behavior, make sure to like the video and subscribe for more insights that help you think differently about your financial life.